I think what you saw in the 90s was a huge run-up. It was over a 500% rate of return in the 90s. Then what happened? The lost decade.
Yep.
2000 to 2010, no rate of return.
Right.
Okay, so what did Morningstar do in July? Release their 10-year report. What do they think the U.S. equity market's going to be for the next decade? -1. That scares the daylights out of me as an advisor. Morningstar, that does all of the analysis of mutual funds and all of these things, they think the U.S. equity market's going to be -1 for the next decade. Well, I hope they're wrong, right? But the truth is if they're not, we as advisors better be doing the right thing and structuring this properly if we're going to go into a lost decade.
Mm-hmm.
Because there's more people retiring today than ever before, right? And I think we've never needed our money to last as long as it has to last now.
Mm-hmm.
And you have this run up now since 2008 to now is a little north of 400%.
Right.
Okay? Kind of like the 90s, not near as good, but kind of like the 90s. Lots of times when you have that run up, you tend to go into a slowdown period. Mm-hmm. Is your portfolio built to last as long as you?
Right.
Right? You don't know till you have it analyzed.
Yep. Yep.
And if it's not, you and I bring it to their attention, right?
That's the
and
job.
they can change it with us, change it themselves, or change it elsewhere.
Absolutely.
Right?
Landon, what about inflation? Touch on that briefly. What do you see? What remedies, what approaches?
Well, you raise interest rates to control inflation.
Oh, yeah.
You ask the economists how you raise interest rates to control inflation, is you got to raise rates higher than inflation to control it.
Yeah.
Are we going to get to that?
Well,
What's inflation? True inflation's like 8% right now?
At least.
Right?
Yeah.
Okay. So we got to get the Fed rate above that? Good luck. Right?
Well, there's not enough taxes to pay the interest on.
Right. We got to get the government to stop spending. They're the one that caused it.
Yeah.
All the quantitative easing under Obama, $4.4 trillion over basically 6 years from 2008 to 2014. They stopped. They left it on the books. The government shuts themselves down, right, in early 2020. Trump's in an election year. He knows, the debacle in D.C., the average person can shut the TV off and disconnect.
Yeah.
However, when it starts affecting your money, your 401k and your investments, right, that can swing votes. And Trump knew that, right? He's no dummy. And the head of the Federal Reserve is put in by the president, but they're not supposed to pander to the president. So the government shuts themselves down. Trump's in an election year and knows, hey, he wasn't elected as a politician, right? He needs to get this market higher by the time election, or he's going to lose a lot of his base and not get reelected. Well, he didn't get reelected anyhow. But with that being said, the Fed printed about $4 trillion and bought bonds in 2020 alone. What Obama did over 6, we basically did in 8 to 10 months. And then Biden comes in and we're doing $120 billion a month.
Yeah.
Right? Well, then in November, Jerome Powell comes out and says, we're going to start to taper about $15 billion. We'll be done by June of 2020. All right, that lasted 3 weeks, and in December he comes out and says, this ain't working. We're going to double down. We're going to reduce it by 30, taper by $30 billion. We're done by March. We're going to do 4 to 5 rate increases, and then we're going to start dumping bonds. Oh, great. What does the market do? It's not going to react well to that. So you get January, a correction in January, which is a correction is 10%. Why did it sell off? I think the market's trying to pressure the Fed. Slow your roll. Yeah. You can cause a crash if you do all that at once, right?
Oh, they're talking 6 or 7 rate increases this year?
Right. And so we got the first one, right, of a quarter of a point. We'll see what they do. But, this war with Ukraine just added a mess to it, right?
Yeah,
and
it
so
did. It was also really convenient on the political news front,
right,
as far as the attention that
COVID went away.
That it took. All sorts of things went away.
Right, right.
I don't know what. Anyway.
Right. So
won't
go into there. But
yeah.
The truth of the matter is it's time for the U.S. Since the 2008 crisis, they've been printing and doing quantitative easing. It's time to tighten the belt. You got the national debt over $30 trillion. You got somewhere between $9 and $10 trillion on the Fed balance sheet in bonds. Outside of that,
that's what you would do if you wanted the country to be healthy,
right,
and survive.
Right. The rest of the world is watching.
Right.
And they're saying, I don't know about the U.S. You hear a lot of talk in the last couple of weeks about the dollar.
Yeah.
Why? Because the rest of the world is watching us manipulate it, and for the previous decade it was, China manipulates their currency. China's manipulating, right? Like, what are we doing?
Yeah.
Right? It's kind of concerning. So I think what you're going to see is the government's going to have to tighten their belt, And
For the investor,
Yeah.
what should they do to fight inflation, to try to survive?
well, unfortunately, with the low interest rate environment we're in, I think you kind of have to be in the markets to try to generate the rate of return to outpace inflation. The good news is the markets historically have always outpaced inflation,
Right.
right? And at our current interest rate environment, you're not going to get anywhere close.
I have a number of clients that are talking about they're selling an asset or cashing something out
Yeah.
so that they can pay off their mortgage.
Right.
They don't realize that a low interest fixed rate mortgage is an incredible asset to hang on to.
Right.
So that's one of our initiatives is to help them out.